Welcome back, traders, to another episode of the Refined Q&A podcast, where we talk everything no-nonsense Forex plus more. Coming to you each and every weekend. My name is Dillon, and I am joined, of course, by Judge. So this was the very first live stream for Judge and I, which we did live stream to the No Nonsense Forex Discord. I know I mentioned in the past that we'll be streaming to YouTube. However, we thought that it might be best if we live stream only in the Discord, and then subsequently we can upload the podcast to YouTube. So I think that works well, and from an administration perspective, it's a lot easier just to follow one live stream group chat opposed to two, being the Discord and the YouTube channel. So I hope that works for everybody. If you do want to catch us live in the No Nonsense Forex Discord, there is a link in the description if you haven't joined the No Nonsense Forex Discord channel, and we'll be streaming live at 8 a.m. every Sunday morning Sydney, Australia time, or every Saturday night at 6 p.m. US Eastern Standard Time. So in today's episode, we are, of course, talking about backtesting and the use of C1 indicators. We go into a lot of detail discussing what is backtesting, what is the methodology of backtesting, and why we actually need a trading strategy or a set of rules to follow when we do trade. We then segue into a bit of detail talking about our main confirmation indicator, or our C1 indicator. We talk about what is the C1 indicator and what is the particular role that our C1 indicator is trying to fulfill. And when it comes to backtesting of C1 indicators, we really understand that when we are backtesting, our indicator must fit that particular role of our trading strategy. In the second half of this episode, we then transition into the Q&A section of the podcast. Now, there were a couple of questions that we did get from the past episodes, which do relate to this particular podcast. We also got another question that did come in live during the podcast, and this is where it is really, really cool to be doing this live and answering your questions as we go live. I think that is something that is going to be very unique to this podcast. Now, whilst doing this podcast with Judge, I did actually learn a couple of things from Judge, and I hope you do as well. And I really like the analogy that he used when it comes to trading and what we are trying to do as traders, particularly trend traders. Now, we are both really excited to be sharing this podcast with you, and we really think that there is going to be a lot of insight that you do get from this podcast, which I think is going to be one of many. So I hope you enjoy this podcast episode, and let's get straight into it. Judge, how's the trading going for the week?
Mate, I'm a bit nervous.
No, I don't.
It's a bit different, but yeah, the trading. It's been pretty, it's been pretty much the same the whole week. It appears. EVZ has been, its usual tricks, quite low, and so there hasn't really been too much going. Obviously, I've had a few signals, and I'm in a few positions, but not really too much happening. But I tend to look at the market as like surfing, to be honest. If there was ever an apt analogy, where the market is like the ocean and the trends are waves, and our algorithm is basically the surfboard that we the surfer is riding. And so sometimes you're sitting out there waiting for waves for a while, and the whole idea is we want to catch that big wave, and I think that's one of the allures about it. Is at the moment we're in a little bit of a low volume, or we're in between sets, so to speak. And obviously what we're trying to do is sit out here and get ourselves in the best position to be able to, take advantage of the next big set that comes through. So at the moment, EVZ's low, won't stay low forever. But that's the week of trading for me.
That's right. And I can more or less say the same thing as well, Judge. For me, it's been a bit of a slow week, actually. Not too many signals for myself, and that is linked to the EVZ as well as my volume indicator as well.
That's a good thing.
Yeah, that is a really good thing because, without going into the detail, my C1 has been getting chopped around the past couple of weeks as well, but this week's been good. The volume indicator has been working its magic and getting me out of those choppy situations. But as well as some of the trades that I have been in have been working in my favor, which is good. So it's managed to get a couple of winners, one break even, and keep me out of the chop, which is, of course, good. And I think this leads me on to my next point as well. And it leads us on really good into the topic that we're going to be talking about. And that is backtesting. So last week you would have heard me mention that I don't do news avoidance. And there's a reason for that. The reason I don't use, I know. It's like a cardinal sin. I don't. The reason why I don't trade or I don't do news avoidance is because in the way I've tested my trading strategy, I actually haven't accounted for it. So if you've followed me on YouTube, you would have seen that I'm into coding, and I've coded the no-nonsense Forex trading strategy in TradingView. And the way I backtest it is through TradingView. I export all of that to an Excel spreadsheet, and then that helps me with my backtesting. The problem is that with that, I have not accounted for news. I haven't put any parameters on that allows me to filter out any news. There's nothing in there in my code that allows for that. And that's the reason why I don't do news avoidance, because my trading strategy is not tested to avoid news. It's tested to account for everything. And because my trading strategy performs through its back testing, and we'll go into forward testing and the live trading and whatnot, because it performs over a long period of time, and that's how it's tested, that's how we should trade our trading strategies, the exact same as when it's back tested. So we're going into our live scenario later on. We should be trading that as close to possible as how it is back tested, and that's why I don't avoid news. Now, is that something that, of course, I'm going to be looking into, later on? Yes, it's something that I've actually thought about multiple times. But being a coder myself, it's something that I can't get my head around. Is it something that I can forward test or do something live and track as I go? Yeah, it is. So that's where I suppose my comment comes in, and it does lead on really well to this podcast, which is backtesting. So, Judge, while we get into it, maybe we can talk about, I suppose, the nitty gritty of backtesting, what it is, and even why we need a trading strategy. I don't know if you want to talk a little bit more on that.
So obviously there is the 3 steps when it comes to creating your approach to no-nonsense Forex. The backtesting step is the first of them, and it essentially is, as I said in that analogy just earlier, it's the surfboard. It's basically the one constant in our trading that gives you the ability to approach the markets day in, day out in the same structured fashion without getting too complex in, how do you create a surfboard or how do you create an algorithm. Ultimately, it has a lot of other purposes other than just, telling you when to get in, when to get out. Mm-hmm. The key to it is it gives you confidence that in the long run, over a long period of time, you have a structure to follow. This is obviously talking about an algorithm, but obviously to be able to trust that algorithm, you've got to have something to benchmark that on. And that's why backtesting is very, very important. But one of the pitfalls with backtesting, I find happens a lot, is people will try and simulate live trading while they're backtesting. So, they'll put in spreads, they'll put in a lot of factors which would happen normally in a live trading process. But you need to zoom out for a second and remember that this is just stage one of creating an algorithm. And, the surfboard is not the market. The surfboard is not, this is just the vehicle at the end of the day for you to get your discipline right so that you are entering when you're meant to be entering and getting out when you're meant to be getting out. So essentially, when you approach backtesting, it needs to be in bite-sized pieces, almost scientific. Now, I'm not saying data science type scientific, but it is a process of observation. So when we backtest, we're starting obviously with a C1 indicator as the main signal, and then we're improving on top of that with other pieces of the algorithm. So the key thing to remember is, it's almost like we're doing small little bite-sized scientific tests on each little piece, just to make sure that they're doing what they're meant to be doing. It's not a simulation of what you're going to be doing in the future. And, that comes into the point that, the results that you get in backtesting will never resemble your forward test, and they'll never correlate with what happens live. And so it's very important to get that balance right and not go overboard. Don't simulate real life situation, because it will actually wreck your psychological expectations of trading in the future.
Yeah, that's right. And I think, Judge, you've raised a very valuable point there. The psychology side of things is, tremendously impacted when we do move forward into other stages. Backtesting, you can work on your trading strategy, you can break it, and you won't lose, any money or even feel the psychological impact, even with the demo trading account and things like that. There is a big step when going from backtesting to the forward testing phase and then to the live trading. But with backtesting, it is very important, and Judge, you mentioned this, that you do take things slow, that you do understand what your algorithm is trying to do, what your trading strategy is trying to do, and you really get and build an understanding of your trading system and each little component of it. And as Judge mentioned, we're not trying to, at the start, build the best trading strategy, or that's the goal. But where you can start off is, and there's another analogy that gets floated around as well, is build the skateboard. So, for example, when we're manufacturing a car or something, we don't generally start off at the high-end car. For example, there is an analogy where if we want to get something up and running and get a somewhat gauge of what the market is telling us, we can build the skateboard first. We build something that's basic, that kind of does everything that we want it to do, but not in the level of detail, for example. We build the skateboard that's something easy to manufacture, to put together, and then once we get a gauge and once we know that, it looks promising, that's when we can go and build the scooter. And then we go and add in a little bit more. We do it in bite-sized chunks, as Judge mentioned. And then we build the scooter. And then from the scooter, we can then build the bike. And then from the bike, we then can build the car. And the car is, of course, the end goal. And that's throughout anything that we do, not only just trading, but if we can break everything down in smaller chunks that is manageable, and we don't get caught up with trying to build, the best thing ever, and then actually not going out and trading anything. We're always stuck in this backtesting phase. It can be very detrimental, as VP, mentions, and we've mentioned it before. Now's the time to start executing. We can execute with something that's, relatively basic, but can still, work. It can still have something there. And I think that's what's very, very important. And that's why backtesting and the methodology of how we backtest is just as important as the strategy. So there is two components of backtesting, in my opinion, and that is the strategy itself and the development itself. But there is another component, and that is how we backtest. And that's what we're going to be talking about a lot in subsequent episodes of this podcast, is how we backtest, the methodology behind it, and how if we, for example, not have a good methodology, then that might be detrimental. And then that's where, of course, having everything in bite-sized chunks so that you can understand it, I think that is very, very important. So I agree, Judge, that this is not a scientific approach, or as of yet. I mean, in subsequent episodes, we're going to go around. I know there's a lot of talk about quants and things like that. I know I mentioned I code, and Judge, we've mentioned before that you also do coding too.
I think the word you're looking for is probabilistic.
That's right.
It's a probability approach still. So,
yeah.
At the end of the day, we're still creating an environment for testing. And that's science at the end of the day. You don't have to be a scientist to test, and you don't have to test like a scientist to be accurate. But what you need to do, obviously, is have consistency and purpose behind your testing. And that's ultimately what the no-nonsense Forex method does. It does have those elements in it.
And that's exactly right, Judge, because it doesn't matter. I know we're algorithmic traders when we do follow no-nonsense Forex, but even if we look at discretionary traders, there is no difference between backtesting in terms of, their methodology behind it. They still have a scientific approach, and the best traders know, for example, how many times they win and how much they win. They also know how many times they lose and how much they lose. And they all look at their performance of their trading strategies, whether that's win rate, profitability, profit factor. There's some quantitative element to it. When I say quantitative, I don't mean like quant, like coding and things like that. I mean numbers and statistics behind it. And that's the skateboard level that we're talking about. We don't want to start off with trying to put together an algorithm that's coded up and everything like that. We can start off with a very basic understanding or basic methodology and then build from it. Because if we jump the gun a little bit, it is often, to our detriment, because then we can be overwhelmed and then we're trying to do too much. And I think sometimes maybe that's not the best approach, and we do lose an understanding of what our trading strategy is trying to do. Whereas if we can focus in and take things in bite-sized chunks, we can build that relationship with our trading strategy, and then we can really start seeing results, I think, from our trading strategy, from the basic numbers and the win rates and things like that, which we're going to talk on. I know there's been a couple of questions on metrics and things like that, but I think if we do start off slow and do really gauge what we're trying to do in our backtesting phase and then build from it as we go, I think that's probably the best way around. Is there anything else you want to add to that, Judge?
I think it's a really, really good segue into the next point of how do we approach and test. What makes no nonsense Forex testing different?
Yeah, that's right. So no nonsense Forex testing is, I wouldn't say it's not unique, but it is very structured, which is important. And the structure of no-nonsense Forex testing does take into account, of course, those bite-sized chunks that you were talking about, Judge. The bite-sized chunks where we're just starting off with, for example, our C1 indicator, and then building from it. And we're going to talk about C1 indicators, but it starts off with the first component of our trading strategy, which is, of course, our trading strategy being a set of rules that we follow. But it starts off with the first component and probably the main component of our trading strategy, trying to understand what that's trying to do, trying to test other indicators, trying to optimize that indicator to build or get the best performance that we can from that particular rule in our trading strategy, and that rule being our C1. Now, from there, yes, from there we keep building on it, and that's where that bite-sized chunks comes in. Once we're comfortable, once something looks promising from testing and optimizing our C1, that's when we move on to the next stage of our optimization and backtesting of our second indicator. And that second indicator can be an exit indicator, or it can be a C1, C2 combination, anything like that. But we're building on something that has performed and that is good. And we keep building on that. And I think that's what's very, very important, because it still takes into account those bite-sized chunks, and it still makes you think about, what is this particular thing that I'm doing? Why is this important? And what is it trying to do for my overall system?
I think
I
think that's actually the most important part of building any system.
Yes.
And is the underlying part of the no-nonsense Forex system. And I think a lot of people will get caught up in statistics because, there is a focus on statistics, because that's how we measure. And it makes us a little bit excited, because this is a longer approach. This is stage 1 of 3 stages of creating the no-nonsense Forex algorithm. Everyone loves to see good statistics, but it's not actually about the statistics. When you're building, and this does tie into curve fitting a little bit. I know we'll touch on this at a later episode. But the actual real secret sauce of no-nonsense Forex indicator choices is what I call piece roles, or, what is the purpose behind your choice? So, to elaborate a little bit on that, each piece of the no-nonsense Forex algorithm has an actual role it needs to achieve first. So, for example, your C1 indicator, it needs to get you into as many trends as possible. And if possible, also keep you out of the chop. But ultimately, its primary role is a signal. It gives you a signal, you go in. And ultimately, it's tried to be tuned so that it only gives you a signal when there's a high probability of a trend to form. So that's the first thing you need to really look at when you're looking for a confirmation indicator, or a main confirmation indicator. If you're looking for a volume indicator, you look at it for its role. You look at how does this volume indicator filter your signal to keep you out of the sideways chop or consolidation periods, or periods which are low volatility or low volume. You need to use your eyes first and look at it to make sure that it's actually accomplishing its intended purpose. And then once you have found an indicator that you can see is actually doing what it's meant to be doing, then you measure it. Then you test it, and then you put a number to it, a statistic to it. And so that statistic isn't to make you think, or set your expectation of what you're going to see in forward testing. That statistic is there so that you can write it down and then move on to the next indicator. And again, first check that the role is, being fulfilled, that it's doing what it's meant to be doing, and then work out, if it is doing what it's meant to be doing, then you can compare the statistics and see if it's doing it better than the previous one. And I think so many people get caught up in the statistic that they just do these tests, especially people who are just dipping their toe into automation and trying to automate their back testing. They will make choices based on the statistic, not on the role. And what that does, that's the beginning of curve fitting. If you are making any decision based on a statistic, or, if you see a statistic and go, I've got, 85% win rate on this one, I'm going to choose this. But you haven't checked that it's getting you into the trends that you're meant to be in, then you are curve fitting at its core. And that is the first step to avoid curve fitting, is just first making sure, using your eyes and checking it's actually doing what it's meant to be doing.
That's a great point, Judge. And I think something that I want to add to that is, when we're looking for indicators, we can get caught up with trying to find the best indicator that not only keeps us in the trend, but only keeps us in the trend when there's enough volume, and, only picks the best types of trend as well. And I know there's an element of curve fitting and things like that in there. I'm not going to get into that. But what I'm trying to say is, there is no one indicator that can do all of that. That's why we use, of course, multiple indicators. We have multiple indicators on our chart that have a specific role to them. The C1 indicator is our main confirmation indicator, of course, and that should be the main trigger that gets us into trades. It doesn't really have to account for volume. We have a volume indicator for that. And people can get stuck, and I have myself get stuck on trying to find the best C1 indicator that does everything. Now, that's more or less of a holy grail. We've heard of that term before. There is no such thing as the holy grail indicator. We're not going to find an indicator, one indicator, that we would put on our chart that does everything perfectly to the T. Often it's better to find really good indicators that are good at one specific role. And that's the whole goal of No Nonsense Forex. And that's where that becomes important. So when we're looking for indicators, particularly a C1 indicator or any indicator, the first thing we need to do is make sure that it does fit the specific role and the intent of that particular part of our trading strategy.
If you actually adopt that approach, and it's very easy to deviate from that. I think a lot of people will not realize that they've gone off the beaten path and deviated from that. But if you get into the habit of just checking the chart, making sure that it's doing what it's meant to be doing when it should be, and don't be too harsh on it. There are going to be times it's going to lose. Everything loses, so don't expect it to be perfect. But if you get into the habit of thinking about ideas of what you're trying to accomplish when you're looking at a chart, such as filtering choppy periods or getting into trends, this will also train your mind to look for nuances in the future. So when we start talking about nuances in the future episodes, those ideas for nuances come from your ability to look at the chart and go, okay, if this happened less, I would be more successful. How do I find an indicator that will make this happen less, this particular condition or whatever? So it's always about the purpose and the role first.
Judge, is there anything else we want to cover as well in terms of backtesting or C1 indicators particularly, or maybe we can...
Well, the main thing obviously is we're moving into main confirmation indicators now, and questions about the main confirmation indicator that we choose, the C1, the anchor. In closing comments on backtesting in general, the statistics part it's still important. You still need to write it all down, and you still need to create an environment so that everything that you're testing in those bite-sized pieces is the same. So, for example, if you're testing one indicator over the same 3-year period, you kind of want to make sure that you're comparing all the other indicators after it with the exact same 3-year period, because it needs to be like for like between them. And then when you write down your statistic, you know that you've chosen it for the right role, and now you're just basically looking at a raw stat, whether it be win rate or whatever that stat is as a measurement is, and you're using the stat to basically narrow down and choose the best of your bunch that you've tested. You're not using it to set an expectation that you're going to have 65 or 70% win rate with your indicator. You're using it purely and only as a comparative method.
Absolutely, Judge. And thank you for closing that. And we can now move, of course, on to the second part of this Q&A podcast.
The fun part.
The fun part, that's right. And I think it's the first time we're actually doing this, being because it's our first time being live, and also the first time that we're answering some of the questions that you have submitted. So I know a lot of people have submitted questions in our past couple of videos, and I do encourage a lot of people to continue doing that. If you got any questions in regards to backtesting, or if there's something that maybe we didn't cover off in our discussions today, we can always revisit that in a future podcast. So if you've got any questions, of course, moving forward, feel free, if you're joining us live, feel free to go to the No Nonsense Forex Discord channel called The Refined Live Show, and we can answer some of your questions there if you've got any. Judge, I know that there is one question coming in as well that I think is really good, that is coming in live, which is super exciting because this is the first time we're doing this.
Hopefully we don't stuff it up.
Yeah, I think we're doing all right so far. So Lavissa is asking us, Judge, she is a coder and she does enjoy, or she is a programmer by trade, and she'd much rather make a MT4 script to do backtesting, especially to improve the time it takes for when we are backtesting indicators. Her question is it a bad idea to do backtesting by code, given what we are talking about today? Judge, I'm not too sure. Did you want to answer that one? And I can also jump in as well and give my opinion on it too.
Short answer, no. It's not bad. What really matters in any backtesting regime, whether you choose to automate or semi-automate or use Soft4FX or use a notepad, is that you're just consistent. You need to have consistent results or data to work with so that you can make consistent decisions. You know, if you tested a whole bunch of indicators and you did it all manually, then you know that those statistics and those results are pertaining to that way of testing. If you then choose to automate your backtesting from there, then it's no longer comparable. So essentially, I think what I've done is I created an environment for my backtesting for all indicators, or starting off with the C1 indicator, and I do automate as well. And I ran them through a set time period, and I ran them through default parameters, and I observed. It is all about observing. It's not about engineering. So I didn't tweak the parameters to squeeze out an extra 1% statistic, because remember, we're not using statistics. I've picked it based on it fulfilling the role. And then I've essentially just run them all through, and I've looked at them and I've gone, okay, well, this one's consistent. And then I'll start expanding if I'm unsure on whether that particular indicator will continue to perform across the other pairs, or I'll test on those pairs too. But ultimately, it's just consistent. So there's nothing wrong with using code. There are other pitfalls with code, because obviously you can have bugs in code, which is why, again, it's always very, very important to check your code and check that the entries are happening as they're meant to. And I think that is also really quickly, obviously, because we're running out of time with questions. But the main thing is, if you are coding and you are testing, automated, please don't have the expectation that you're only doing this because you think it's quicker. It's not. There are other things and other factors that you're now going to have to consider when it comes to execution, from bugs to ticks, and there's just a whole nother world when it comes to execution. So if you think that by learning to code, or by using FX Dreamer or TVX or one of these other build it type EA creators, that you are going to save time, then you are going to be sorely disappointed, because if you're going to continue to do it right, it'll probably take you the same amount of time as manual, if not more, to do it right. And that's where I think a lot of people have got in a bit of trouble when they've jumped from manual to automated, is they'll jump into automated thinking it's going to save them time, but all it does is help them shortcut quicker. And shortcuts don't work in the long game.
I can definitely testify to that, Judge, because for those people that have found me on YouTube, I've mentioned this before, but it's taken me 4 to 6 months to actually learn how to code and do that, and put the no-nonsense Forex trading strategy into TradingView Pine script. It's taken me 4 to 6 months to do that, and then for it just to start spitting out results. And every day after that as well, I'm still learning different things on how to code. Now, coding is something that I enjoy, and that's why I've done it. But in terms of a time saving, there is a bit of investment, time up front, to actually get your algorithm coded up and tested for bugs and everything like that, just for it to spit out a number. Now, of course, there's pros and cons to it all, and Judge, you've touched on this a bit as well. It's kind of a 50-50 either way, in my opinion, this one. And this is a really good question, because I think with coding, once it's all coded up and everything, you can spit out a lot of results fairly quickly. That's notwithstanding that there is, of course, a time commitment to actually get it up to speed. But once it is coded up there is, benefits for having that code ready to go. However, and this is what we've touched on, we do lose the relationship of what your actual indicator is trying to do. We're not actually going into back into the charts, and well, we should be, but if you're just looking at the numbers and the statistics, often what you're trying to do is find the best profit factor, find the best win rate, but we're not actually seeing what our trading strategy or our actual test is trying to do. Does our actual test get us into the best trending trades? Does our actual test fit with the underlying premise of what our indicator is trying to do? And that's what you lose with coding. Now, if you are coding, I would encourage anyone to make sure you do go back through your backtest and revisit not only whether your indicator or whether your code is performing properly, whether it's entering when it should be entering, when there is a C1 crossover or whatever, but is it actually fulfilling the role it's meant to? And that's what's important. There is no way of getting out of that. You do have to go back and make sure, whether you're coding, go back and make sure that your code is doing what it's meant to do and your indicator is doing what it's meant to do. Mm-hmm. And that's what we have to do. Is there another question you might have, Judge? While I sift through and maybe get another one later? Is there something you
I definitely have one here. I've got a few here, which have come in during the week, which I think are really pertinent to this particular episode. One which came in from Lumpy Dumpy. Love the name. It's what makes a primary confirmation indicator good? Now, I'm sorry if I haven't read out your question identical, because sometimes some of these questions are quite long, so I've just summarized them and paraphrased them. So what makes a primary confirmation indicator good? For me, and again, trying to keep this as quick as possible because we're on a time here. The keys that make a primary confirmation indicator good is, as we were saying before, check that it fulfills its purpose, so it's getting you into trends. And as a side note, if it keeps you out of false signals, what I call a false signal is if it gives you a signal and it's not really a trend, it's just a bit of volatility in a sideways market. If it filters that, that's great, but ultimately you want to make sure that your primary confirmation indicator is in as many of the actual trends we're meant to be in as possible. And so when I say actual trends, you may remember VP said that there's usually a handful of major trends, or what we've called in the Discord before, mega trends, that makes our profit for the year, or for whatever we're doing. And so you ultimately want to make sure that that indicator gets you into those mega trends.
Have to.
It's probably going to get you into a lot of other minor trends here and there. But remember, the minor trends are the little ones where you just break even. They're there to absorb and help you sustain the losses. Because the fact of the matter is, you will lose. And that's, it doesn't matter what indicator you use. You need to accept the fact that this is like... the market is a journey. It's like riding, going back to the surfing analogy, you are going to catch some big waves and you're going to have a good time. But you are also going to get dumped a lot when you're learning. And you need to be able to take that, on the chest and, and get up and get back out in the lineup and wait for that big wave. Obviously, with primary confirmation indicators, we're looking for the no-nonsense Forex way. We're looking at zero-line indicators or two-line cross indicators. But both of these, at the end of the day, they're actually average maths. So they're based on oscillators or a moving average. So they're lagging. But that's essentially... the reason why we use an average or an indicator which is not, that is a lagging indicator, like it has a moving average built into it, or some sort of math which is applied to it that gives an average, is because averages can adjust with the market over time. So, having a two-line cross or a zero line, sometimes it'll be early on trends, sometimes it will be late because it will wane in and out of relevance as the market adjusts, because the market is always changing. But using a zero line or a two line cross indicator to give you a signal is knowing that it's always adjusting over time based on the past data of the period that's just behind it. And that allows you to hopefully get a more robust algorithm at the end after you start filtering it, because it is always updating its averages within it. And, if the market shifts and the regime shifts and, the market changes from a volatility perspective, it might take a few candles, but it will adjust because it's an average. And that's how we know that it'll be a long-term indicator. And then once you've got that, when making your primary confirmation indicator good, obviously you want to observe the win rate and write it down. Obviously, the higher the win rate over your test period, the better it's performed. It doesn't necessarily mean it's better than any other indicator. It just means that it's doing what it's meant to be doing, and it's giving you a higher probability of wins than losses. And that's it. Then once you get a list of indicators which have a higher than normal probability of wins and losses, your money management and no-nonsense forex will do the rest. And that's it. So that's right. I don't know if you have any bits to add to that when it comes to what makes a primary confirmation indicator good.
No, that was a great, Judge. There's one thing that just came to mind. I know a lot of people, particularly following No Nonsense Forex, would understand that the ATR is designed to adjust our money management as the market volatility changes, as the market adjusts. A lot of people understand that in terms of the ATR. Your C1 indicator and your other indicators are not that much different. Your indicators adjust as the market adjusts as well. So when Judge was saying on that point, if you want something to refer to, I think being no-nonsense forex traders, we all understand the ATR and how it adjusts as the market adjusts. Your other indicators are no different to that, in my opinion. I've got another question here that came from YouTube from Hamad, and this one is actually a really good one that I'm happy to talk to first. Of course, Hamad says, how do you know when you have found the best confirmation indicator to stick to when going into the forward testing phase? What are the factors you need to consider apart from only win rate, and should you change the settings of your indicator, or should you just leave them as default? For the first part,
I think I touched on that.
Yeah, so we've definitely touched on this a little bit. And I think, how do we find the best indicator for when we're moving forward? I just want to add to this on what we've already touched on is there's a quantitative approach and a qualitative approach. Now, remember, when I say quantitative, I don't mean, quant trading or anything like that. I mean numbers. But firstly, qualitative. And the qualitative approach, and for those that don't know the difference between qualitative and quantitative, just remember quantitative is numbers and statistics. Qualitative is everything else. I don't actually know the definition of qualitative, but what qualitative is the first thing that we need to do is make sure that we understand what our indicator is supposed to do and whether our indicator that we are testing actually fulfills that. Does it fit the fundamental premise of what our actual indicator is meant to do? And being no-nonsense forex traders, is our C1 indicator fulfilling those big trends? Or is it a trend indicator, and is it capturing those big trends? And Judge, you did touch on about this. So every time that we look at an indicator, we need to do, I guess, the eyeball test. And VP does touch on this, but we need to just quickly go back through time and just see, does it actually capture the trends? And from there, we need to make sure that we are getting the signals which we want to be getting, but also maybe try to avoid some of those bad signals and maybe filter some of those out. Of course, we're going to be adding to our trading strategy, but we want to get a little bit of a gauge of what our indicator is trying to do, and that's the qualitative approach. Now, the quantitative, and this is where the question asks about win rate and other statistics and stuff like that, that is qualitative. So that's where the numbers come in, the statistics come in. Oh, sorry, quantitative. Sorry, apologies. Quantitative, remember quantity meaning number. That's how I remember it. And I've clearly stuffed that up live in front of everyone. So quantitative, we want to be looking at win rate, of course, but what else should we be looking at? I know we mentioned, or maybe we haven't yet, but we also want to be looking at, the number of trades we're getting. Is it too fast or is it too slow? Our eyeball test can kind of gauge that. And the more times you do it, the more times you'll see certain patterns and maybe see a bit of a rough area of, what works well and what doesn't. The more times you do this, the more indicators you look at, the quicker you're going to be at this. But number of trades can be important when it comes to quantitative. Is it too fast or is it too slow? We also want to look at profitability and profit factor. If you want to measure this, of course you can. And then we can, look at these numbers and then possibly build off that moving forward. Now, of course, we mentioned that the numbers aren't, everything. But if we're, this can be helpful, in my opinion, to give a little bit of a baseline of, what we're building. We can build on this moving forward. So for example, if we take profit factor, and for those people that are into the numbers and understand what profit factor is, all profit factor is doing is taking, the number of our, how much we've won versus how much we've lost. Now, you also, when you're looking at numbers, you also need to understand what the numbers are telling you, just like, for example, profit factor. Now, in theory, if we want to start building off of this C1 indicator and keep building off it, and we are using profit factor as a metric, we want to see, once we keep adding different indicators or once we keep optimizing our indicators, we want to see our profit factor increase. Because if our profit factor is increasing, then of course we are getting more money or we are not losing as much money, and that's how the profit factor operates. So in theory, we should be increasing our profit factor, and that can serve as a little bit of a baseline for when you're trying to develop your strategy moving forward. Notwithstanding, however, that you do need to do the qualitative stuff as well.
You got it.
I got it. The qualitative stuff is so important, and you still need to make sure that your trading strategy and your indicator is serving the purpose of your trading strategy, and that's really the most important thing. The quantitative stuff, yes, the numbers are good, yes, you can measure the numbers, but it's not the only thing when it comes to trading strategies, and we've touched on that as well. So it's both quantitative and qualitative, and that's what we must remember.
Couldn't agree more. Kind of segues into, I think we've got time for one more question.
Judge, I think you might have one more, yes?
This was from Solomon, who, again, I'm sorry, I'm paraphrasing it, but it kind of leads on from the last question as well, and what your comments were. Essentially, what he was asking, paraphrased, is there a minimum number of trades to be called good one or not? So I think basically what he's saying is there an actual number or a number amount of trades that we need to be doing these tests over? I think he's referring to sample size. Mm-hmm. Short answer is yes, there is a minimum number. However, the answer to the question is not a set number. What I believe, you need to be testing over whatever amount is required to get a stable win rate. Now, I'm talking about confirmation indicators here only, so not whole algorithms. But when I'm testing, for win rate on confirmation indicators, because I'm using the win rate to compare, essentially, the faster the indicator, the more trades you're going to get. The slower the indicator, the less trades you're going to get over the same time period. But then there's this other factor which comes in, which is, if you test 10 trades and 7 win and 3 lose, that's a 70% win rate. But if you take that same indicator and you put it across, 50 trades, that percentage will drop because you're getting a larger sample size. So over 50 trades, you might get a 64% win rate, but say over 100 trades, it might even go even further down to say 55%, which is 55 wins and 45 losses. So essentially what happens is the more trades you add, or the larger the sample size, the lower the win rate is going to go. But it'll reach a point where it'll hit like a point of no return where it'll actually stabilize. And so it doesn't matter how many more trades you add, it'll always hover around the same percentage. And it's at that point that you're good to go when it comes to minimum number of trades. You may not need to go that deep when you're just looking to choose a good C1 indicator at the end of the day. As I said, with backtesting, you're not going deep. This doesn't correlate to forward test or live testing at the end of the day. All you're trying to do is compare it with other indicators. So you don't really need to go that deep. So you can probably, choose 3 years and go across your benchmark 5. But essentially, if the number of trades is not enough, and just say I pick a C1 indicator and it's a lot slower than all the other ones I've tested, and I run it through the benchmark 5 over the same time period, and it tends to be about half the number of trades of all the rest. Then I will probably just do a side test and I'll expand out the years, or I'll add in other pairs just to make sure that win rate is stable. And I'll use that percentage as a side percentage. I'll still keep the original lower sample size percentage because that's the true comparison over that time period. But I'm just satisfying my curiosity knowing that it is stable across the same number of trades as what, say, a faster indicator would give me. So in summary, there is no right or wrong answer. There's no magic number when it comes to number of trades, because obviously if there was a magic number, it would be infinite, because the bigger the sample size you've got, the better it is, the more accurate it is. But ultimately it's got to be a balance between what you're actually doing, and you're comparing trades at the end of the day. You're comparing indicators. So you're trying to find the higher probability to have one that's stable. So if you can work that out over, say, 3 years and it's 200 trades, or 3 years and it's 100 trades, and that win rate is kind of stabilized, giving you an indication that it's probably going to stay stable a lot of the time in the future at that type of win rate. Well, that's your edge on that indicator. That's the edge. And the edge is not what wins you money. The edge is not what makes you a successful trader. Your psychology and your money management will contribute to that. So the three parts: psychology, money management, and having an algorithmic edge. The three together is what makes you successful. So ultimately, once you've got that edge and you know it's stable, then you move on and you compare. Do you have anything to add there, Dillon?
Yeah, I just want to add, thank you, Judge. I just want to add one quick thing, very minor. Judge, I know you mentioned with 10 trades, we might have a 75% win rate, and then with 50 trades, it goes to 64. And then, for example, 100 trades, it's a 55% win rate. And then it starts to do that plateau type thing. The same is true if we do test an indicator that at the start, it might not look like it's performing well. For example, if we test 10 trades and it only has, for whatever reason, a 35% win rate, we can't discard that particular indicator. Of course, now we mentioned, we do the eyeball test and we look at the qualitative approach to the indicator. In our eyeball test, does it look like it fits in? Now, yes, it looks like it fits in. It looks really good. We go into the quantitative approach and we start actually testing the indicator and looking at the win rate. We've tested the first 10 trades and then we go, oh, wait a minute. I've tested 10 trades and I only get a 35% win rate. I'm going to throw this in the bin. That very indicator that you've thrown in the bin, if tested over 100 trades as well, might actually be a 65% win rate. It just so happens that the small little period of time of 10 trades, which might be, a couple of weeks or maybe a month if you're testing, over the 5 main pairs, those particular trades might just so have happened to be, a small losing period for that particular indicator. The rest of the time, however, the other 90 trades that you have tested may have been very, very profitable and very promising. So it also goes, the other way around. Don't just throw out indicators that don't look promising off the bat when you're doing your quantitative approach. If you've done the eyeball test and it looks like it will get you into some of those really big trending trades, that should be the first stage that it passes, and then that should warrant you to actually trade and to actually backtest that indicator, for example, 100 trades or something, or whenever it starts to plateau. Now, I know we've used 100 trades, but there is no number It's where we start to see consistency of the backtest, and we start to see that plateau effect, that flattening of the curve of our win rate, for example. So it can go both ways.
Yeah, and if you only do the benchmark 5 and you find it hasn't plateaued yet, then expand to more pairs, and you'll find you'll get more trades then that you can compare it against.
That's right. So I believe
I think that's it, isn't it?
That's unfortunately, we can continue, talking about this, and I know there's a couple of other things.
5 hours.
Exactly. But definitely, if there's anything that we've missed, of course, we'll save it for future videos, because I think we're going to, eventually cover off everything anyway. So in today's episode, of course, we have covered and touched on what is backtesting and why it is important, and why we need to have a set of rules or a trading strategy in place. And of course, we need to test that strategy too. So there was those two components. There is the backtesting and the strategy side of things, but there is also the methodology of how we backtest that is really important. And that's what we did touch on, especially a lot at the end. The methodology, we're doing the qualitative and the quantitative approach. We're not just looking at win rate. We're doing the eyeball test. Does this particular indicator fit with the trading premise and the rule, or what is a C1 indicator? Does our particular indicator fit with, what is it meant to be? You're not going to take, for example,
it's roll.
Yes, it's roll. You have to make sure that your particular indicator fits with its current role, as Judge mentioned. We also touched on a lot about a lot of really good and interesting questions from the community that we have had, and one being live as well, which was a lot of fun too. And I hope we, of course, answered those questions in a bit of detail. But of course, as Judge mentioned, we could spend hours on this and go through it and really hash out everything. So, of course, we're going to be coming to you next week with another topic, so stay tuned then. So Judge and everybody, appreciate all of you for joining in. Is there anything else you want to say, Judge, or I think that might be it?
That's it. See ya.
Awesome. Thank you all. Appreciate the time, and have a good day and happy trading.